Joining us now with more on the market, Sarat Sethi, DCLA portfolio manager and a CNBC contributor. Sarat, as it happens so often with your style of investing, you're looking for places to stay invested that it might weather whatever storm is on the horizon. We don't know whether it's a tropical storm, a Category 1, a Category 2. We don't know what it is that we're on the front end of. But you say buy stocks, buy companies that are going to continue to have strong earnings, and you are somewhat insulated from the macro.
I do, and Joe, you made a good point. We don't know if we're in the front end or something, or this is just kind of a short-term blip, but we do know one thing. I mean, the yen trade, the carry trade has a lot of unintended consequences. So does that mean we're going to get another tornado? We don't know, right? So you've got the momentum investors saying, hey, maybe we watch for a while, see what's going on. You know, I look at it through the lens, as you said, hey, there's some really good companies that got sold off that had nothing to do with, you know, maybe the market was overvalued, or we had a few other AI bubble. So I look at it and say, if you're a long-term investor, find the high-quality companies, and then also look on the edge to say, what are some of the companies that I couldn't buy before just because valuations happen? And Joe, and you and I have talked about this in the past. If the Fed is going to cut rates, which looks like it is, then you can't hide on bonds anymore. So why not own really good companies that have cash flow and dividends that grow faster than inflation? You're getting a combination of capital appreciation and income growth. So I do think you're going to find opportunities, as I call them, fallen angels. And I think if you're a long-term investor, and over the years you've made money through this, and it just hasn't been over the last 5 years or 7 years. It's been proven over a long time.
We were trying to figure out, okay, so a technical thing, people do the carry trade, they love doing that, it gets unwound. But what causes it? What's the actual cause of what happened? That's what I'm interested in. And we stayed at zero for a long time, Sarat, and we talked about, what the long-term consequences of pricing assets below, where cash doesn't cost as much as it should. So you get malinvestment, you get all these things that happen. So then the Fed feels the need to harness the inflation that it engendered, and they're restrictive. So
right.
We need to know right now how maybe they were much more restrictive than we knew at the time. Maybe inflation was supply side, maybe it was pandemic related, and maybe they killed the goose that laid the golden egg. Maybe it's already too late. Is that not possible?
That definitely could be possible, but I do think that you have a Fed that's very aware of it, and they're looking at inflation at this point, and they're looking at price stability. And also what happened in Japan, that's just a function of a lot of leverage and rates being really low. And the offset, the interesting part is that if we cut rates, that hurts Japan. So it's a lot of this momentum CTA money as well. But at the end of the day, if the Fed is even one step behind and they start cutting rates, you can actually get, I think, better price momentum here, because certain stocks will do well, especially if interest rates come down, the cost of borrowing comes down, consumers feel better. And you really haven't seen the bad data yet. And maybe it comes, but if it doesn't, these are the opportunities we get, the corrections, especially as we go into, we're probably 60% into earnings right now. So I do think there's going to be quality. And Joe, what are you going to do? You're going to start buying bonds at this point? I mean, those who had owned bonds, they're going to start maturing. Rates are going to come down already. So I think you're going to have some good opportunities to grow your capital.
I could see a couple of different scenarios. I could see where this is a blip. The markets have run up so much that they were obviously looking for a reason maybe to just give back a little of the incredible 2-year gains that we've seen, especially in the S&P. I could also see it the other way, Sarat, and that's that this is, yesterday's sort of was a pre-shock of something that could be much more serious. It causes the Fed to do that interim 50-pointer within the next month. That's possible, right? Before September, if this gets out of hand, and we're in that period of the year where October's coming, I mean, if we got another couple of days like yesterday, the Fed might think, okay, we stayed too long, too high, too long, and that would get
the offset of that is then you get even people more nervous saying, what did the Fed miss, right? So that was the reason we were all saying, no matter what, now, what is the Fed seeing that we're not seeing? So I would say this, and you know me long enough, I always say this, if you're outside your comfort zone, don't chase the market. Never chase it when it's going up, and don't chase it when it's going down. If you're going to rebalance now, or you have extra capital that you've been waiting for, we always talk about, oh, I have extra capital, don't chase the market. Look, this could be a time you put some of it to work, and you get the market gives you better opportunities. And if it doesn't, you're going to get better opportunities in certain stocks or sectors. But don't chase it, especially if you're going to be outside your comfort zone, because you're absolutely right. This could be a one step down to another market correction further, or we could just be, quote, the growth blip and, buy when the market comes down. So, and the other thing is, look, some of these stocks have gone up so much. Why don't you just rebalance on some of the ones that have gotten, like Warren Buffett did? Large positions that have become too large, take some off the table and maybe rebalance those.